that's the short answer is you need to know what you're getting. You need to know more than investments. Like I think this is one of the areas that if that's all you're getting, if all they're doing is investment management for you and they're charging you 1 to 1.5%, and there's a 1 to 1.5% expense ratio below the hood, below the line, I think you're in trouble there. You're not going to make up that 3% drag. And if you don't pay attention, you're going to be frustrated 5 and 10 years down the road, and you're going to give way too much of your return away.
There have been several things that for whatever reason they come across my feeds kind of bashing wealth advisors and financial advisors. And so the first one I kind of want to bring up is the infamous article about Warren Buffett making a bet that a hedge fund manager wouldn't be able to outperform the S&P 500. And the article, and we'll share it with the people who are watching, it uses some interesting terms that I think that you can take as much time as you'd like to clarify, but it talks about how financial advisors can't outperform the market. Then it talks about fund managers not outperforming, and then it talks about hedge fund managers, which is what Warren Buffett famously challenged. So maybe you can dive into that. Is the financial advisor's role to outperform the market, and then kind of where do you come in for people?
So first of all, no. The answer is the financial advisor's job is not to outperform the market. However, I think they should try. I think they should try, and I think they should succeed in many, many environments, but not in perfection. But let's take a step back for a second. There are a lot of really awful investment portfolios built by financial advisors. So, I mean, empathize a bit with the audience here. There are a lot of people who really, really suffer and don't know it. And the language usually is, I've been working with this financial advisor for 5 years, and I just don't feel like my portfolio is efficient, or I don't feel like my portfolio makes very, very much ground. And most of the time, that's an inefficiency in the portfolio that's either too conservative or it is too costly. So I guess we are going to talk about the reasons why financial advisors, let's just call it some financial advisors, can do really, really well for their clients. At the same time, I don't want to come across like all financial advisors are great, because they're not. And while I hope the industry as a whole gets better, but it does provide us a little bit of a competitive advantage. So we'll take that, I guess. But I hope for the client's sake that it all gets better. So going back to your terminology, financial advisors, because in that article, I think we found it Yahoo, right? Mm-hmm. In that article, the header talks about financial advisors, the body talks about fund managers, and the bet was against hedge fund managers. So let's start with a hedge fund manager for a second. A hedge is de-risking something, usually. Like a true, let's say someone needs to, like back in the day, they need to deliver a certain amount of cattle or corn, cotton, a commodity of some type. They have to deliver a commodity of some type. And they need to come up with that commodity in the future. They can actually use what's called a future. They can hedge against it and either buy or sell the asset to be delivered in the future. An option is the same way. You can have the right to buy or sell a stock or an index or some measurement in the future. So it's important to understand what a hedge really is. The problem is that the word hedge fund has become synonymous with do whatever the heck you want. Mm-hmm. So that's a little bit of a problem, but hedge fund in particular has really, really high fees. Generally, they take 2% of the annual portfolio and 20% of the growth. They may have a hurdle at which, they make that 20% after a certain amount, but those are the better maybe of the group. But a lot of them they call it 2 and 20. So yeah, you're going to pay a lot in fees, and that right there is an investment structure that better have some serious exclusivity, potential investment opportunities that don't exist otherwise, or you are definitely not keeping up. And so I think that's part of what Warren Buffett was arguing. And Warren Buffett talks a lot about, just buy the S&P 500 and if you don't know what you're doing, but then he doesn't. So there's something he's doing there that's different, and there's a reason he's doing it different, right? Okay, so that's a hedge fund manager. And the bet, I actually love this. I love this story. So the bet was that they would put up a certain amount of money to go to charities, and for a decade, they would bet each other. And Warren Buffett I don't think he disclosed exactly what fund or investment he was going to buy, but that he could pick one fund and it would outperform hedge fund managers. He threw this out there and let any hedge fund manager take him up on it. And one company came and said, yeah, we'll take you up on that bet. So they did it. And hedge fund managers typically do really well when markets go down or they're really volatile. There's some opportunity there. But then markets did really well for a while. And I think they were like 7 or 8 years in, and the hedge fund manager just conceded and was like, we lost. And no surprise there. You got a couple things going on. Generally, on a positive market, the S&P 500, I expect it to outperform hedge funds. Hedge funds are paying some amount to de-risk or do something different than the portfolio, right? So if you're paying some sort of an amount to hedge against the downside, you're not going to keep up with the upside. And so if the market is positive, you're not going to do as well. Also, the 2 and 20 structure is really hard to overcome. So that's another problem. So far, we haven't talked about financial advisors yet.
Yeah.
So maybe we get there, but the first thing for the folks to understand is the S&P 500 and a hedge fund, neither of those are really telling you whether you should double up your charitable giving this year or what kind of an estate plan you should have. That's not in that conversation. In fact, you don't get to talk to either of those people.
Yeah.
So that's maybe one contrast and difference to understand. Then we get to investment funds, just standard investment funds that don't have the 2 and 20 structure. Now, within investment funds, there are index funds. So once again, we need to be careful about terminology here because there are great investment funds that are index funds and cost you 0.0 something % per year as what's called an expense ratio. So if we can draw a line and say certain costs are below the line and certain costs are above the line I define as what you see. Now you can find the quoted amounts, what's below, but it's really hard to quantify exactly how much did Erik pay when it's below the line versus above the line. An advisory fee for a financial advisor or wealth manager being billed quarterly is above the line. You can see that. A flat fee for planning, a project-based plan, or a retainer, that's above the line. You can see that again really visibly. You know exactly how much the Soderbergh family paid. I just disclosed your last name.
It's okay.
It's okay.
No,
okay.
it's everywhere.
You can figure out how much your family would pay above the line, right? How many dollars you spent on expense ratios, meaning that percentage of the underlying funds, is really hard to quantify because you don't know exactly when and how they take those fees because it's built into the share price of those funds throughout the year. So that's below the line or under the hood. Expense ratios are built in there. I think there's also inefficiency in how those funds are managed. So sometimes they have to hold a lot of cash in the portfolio because maybe you want to hold on to it, but your neighbor wants to get in it and then later wants to get out of it. The whole time you're a long-term investor, but the fund had to buy and sell during your lifetime of the fund. So that creates transactions, creates some friction, creates the need to keep cash on hand when you have, millions or thousands of people, whatever the number is per fund. So those are investment funds. There are index investment funds and there are active. And so the terminology is passive or active. Active doesn't mean day trading. It means that you're doing active research on the individual positions. And when I say you, I mean the fund manager. The fund manager is doing active research on the individual positions with the idea of outperforming. Outperforming does not always mean going up more than, right? Outperforming could mean going down less than. So there's a different focus. It could mean creating more dividend yield than the S&P 500 or an index. It could mean having a lower standard deviation, which means the highs and the lows of the S&P, if it's here, maybe the fund is trying to create minimum volatility. That's a terminology you see in fund names, like a min-vol strategy. So outperformance could mean one of many things. But if you're talking about just outperforming the S&P 500, it can be really hard to do. There are funds and there are managers that do it. We personally like to connect with those managers that do well, and then we like to take their intellect and apply it to our clients' portfolios rather than taking our clients' portfolios and sending the assets to the fund. We can get rid of the expense ratios that way. We can get rid of some of the inefficiencies of the neighbor trading example. But without getting too much into what we do, we're still talking about somebody who will not give you advice on when you personally can retire, your tax strategies, your estate planning, your spending amounts in retirement, your saving amounts pre-retirement, all of that. We still haven't gotten into financial planning.
Because you, even on the last time that we talked about this, you had mentioned that fund managers are usually not client-facing. Like a fund manager is investigating those real estate options, or whether it's minerals or whatever else for that fund specifically. They aren't sitting down with the client and interacting with them and making those decisions.
Yeah, and some of the designation differences, this might help people understand. CFA, Chartered Financial Analyst. There are 3 levels of the CFA. It's a grueling process to make it through the CFA. So you have to be really, really technical and very into the analysis and the risk management and the portfolio construction side of our business. If you are a CFA, generally the people that make it through the CFA are not really interested in talking to people a lot every day. Now, there are some people that are just talented on both sides of the brain that way, and they're very, very technical, and they are presenters or they are relationship people, and those people make insane amounts of money. They're not your normal person, the reality is somebody who gets the CFA, they really want to look at numbers, data, and the environment, make predictions, do risk assessments, all of that. And they're probably not going to be talking to you about your family and wishes and desires, dreams, and how to marry your money to that. The Certified Financial Planner designation is it's the most popular designation. There are so many of these. There's not a way to count. I don't know how many there are, but 20, 30 plus designations, for like a charitable planning consultant or divorce. A team member of ours has the CFP, the Certified Financial Planner, but he also has a designation that says that he knows what he's doing with regard to financial planning around divorce. So there are many designations that you can go and achieve that will help the consumer know where you specialize. But the bottom line is just remember the 2, CFP, CFA, analyst, planner is the last letter of the 2. And you're probably not going to end up talking to a CFA. If you do, the CFA is likely. I actually ran into someone just this week that they were talking. She was talking about her financial advisor, and it turns out her financial advisor is a CFA and doesn't focus on anything in their conversations other than the investments. So yeah, that's okay. So maybe let's take a step back. So different professionals are involved at different parts of the process. And we still haven't gotten to who's actually advising the individual, right?
Which is what the whole title of that article is.
Right, that's true.
The body and the conclusions are all about what you've just talked about, but the title is...
Well, it does say investment advisor.
Yeah.
So there's a little bit of difference between financial advisor and investment advisor. So we're not going to be too mean to Yahoo, I guess.
Okay.
But it does say investment advisor. So the reality is, if you are investments only as a financial advisor, then there is some value to what you do. It's not 1%, in my opinion. Now, Vanguard has a study, which we'll talk about today, that does say that you actually can make back 1% as an investment advisor only, but I think you need to be doing it in more than one component of financial planning, which is investments. So if I can sum all of this up, yeah, the S&P 500 can and often does outperform hedge funds because they're trying to do something different than the S&P 500, and they're expensive. The S&P 500 can and does outperform investment mutual funds often. I guess my question then becomes, how do you know which index to buy, because the S&P 500 is only one. And most people want some help knowing, well, how much international should I own? How much of the small and mid-cap portions of the market should I own? How much should I put into bonds? And if I do put some into bonds, should it be short-term, intermediate-term, long-term, high quality, or low quality, higher yield? Those are all different categories that you can make a really great portfolio that's risk managed with index funds, but you usually need somewhere between 5 and 12 different index funds to give you exposure to those asset classes. And so the question then is, how do you know what percentages? Now, there are some great newsletters out there. If you're like super DIY, there are some really great resources that will give some opinions, and you can break apart some of the funds that companies make, and they actually package some of this up into one fund. You could go look at the prospectus and see how they're packaged and just copy a Fidelity, a BlackRock, or something like that. So, but once again, this is a little bit more technical, which you do have listeners that are that way, but a lot of people are like, I'd like to talk to somebody about that.
Yeah, for sure. And I think that we have a couple of different audiences that would watch this. And you mentioned one, the DIY group, right? I don't want this to be like, hey, everybody should use a financial advisor and run and find somebody and pay whatever they're asking, because that's definitely not what we're saying. There's a DIY group that, to your point, can go and do the research themselves. There are groups of people that don't want to do that. And I fall in that group. I don't want to spend the time to do that. And I don't know that I have the capacity to do that in terms of like what I want to do with the investment side of things. So those two groups there. And then the other thing that we would want to do, I guess there's a third thing too, but the second thing is tackling kind of the bashing against financial advisors, which we're stepping into. And then the third is it worth it? Is a financial advisor worth it as we start getting into the different fee structures?
Yeah. So first of all, let's let everybody bash, because there's plenty of the people in our industry that are awful. So that's great. Go for it. Let's be hard on them. You know what I mean? That's fine. The one, like a 1% fee, is it worth it? In some cases, absolutely not. In some cases, depending on what you're being offered, absolutely not. And in some cases, your financial advisor can earn that back for you 3 or 4 times. So it depends on what they're doing, which we need to get into today.
Yeah.
But that's the short answer is you need to know what you're getting. You need to know more than investments. Like, I think this is one of the areas that if that's all you're getting, if all they're doing is investment management for you, and they're charging you 1 to 1.5%, and there's a 1 to 1.5% expense ratio below the hood, below the line, I think you're in trouble there. You're not going to make up that 3% drag. And if you don't pay attention, you're going to be frustrated 5 and 10 years down the road, and you're going to give way too much of your return away.
How do they find that out? Like, what question do they ask to find that out?
Okay, that's fair. I mean, I would usually say, I'm trying to think about how can they find that out without asking us what their advisor, you know what I mean? Like, without talking. Obviously, we would talk to people, but I'm trying to think, like, how does someone figure that out without talking to someone who's in the industry to help them assess it?
Even their own advisor, right? If they go to their own advisor.
Yeah, I mean, usually it's good to go to your own advisor. I think that is one of the answers. Ask your own advisor, like, hey, can you lay the fees out for me? How does this work? And just be super open like that, and let the advisor talk to you, because it's a sensitive subject on both sides, right? So don't come in guns a-blazing and just say, tell me how the cost structure, and that's a good way of asking it, the cost structure of all this works. Can you help me know, like, who the different parties are involved on my portfolio, and how everybody makes money, and then see how they respond. Some financial advisors will struggle to give you an answer. Now, that might not mean that they are trying to hide something from you. It just might mean that they're not super comfortable in their skin yet, which they may actually be providing really great service and be worth it. They just might not be really confident in that yet, depending on how they communicate it. So, but that can be a sign, like, if you can't just tell me straight up, do you not believe you're worth it? So that's a problem. And then when they tell you their fee, maybe they say, oh, we charge 1.25%, or we charge 1%, or we charge 1.5%, whatever that might be, or we charge 0.75%. Say, great, okay, who else makes money on the portfolio, and how does it work? And just stop there and let them answer that question. Then take the funds and just grab your statement, take any symbol that has 5 letters with an X at the end is a mutual fund. And I would take any of those, and I would throw them in Google, and you're going to find it'll probably push you to Yahoo or Morningstar or one of the few or other finance sites. But then you click on it and just look for the expense ratio, and you'll find some number of 1 point something to 0 point something. That's an additional cost that is not included in the amount your financial advisor told you about, most likely, unless they specifically said we charge 1% and the expense ratios on the portfolio are 0.09% on average or something. If that were the case, they're using index funds. So anything below 0.2% is most likely index funds, and anything around 0.6, 0.7 and up is an actively managed investment. In between those two numbers, it sometimes can be hard to tell. You might be just paying for an expensive index in between those numbers.
Well, and I think those questions are important. You mentioned like if they are able to answer straight up, it's 1% or 1.25 or 0.75. In my mind, where I think we would like to go with this is like, okay, well, what does that get me? You've talked about basic investments, but you've also hinted at a bunch of other things that a financial advisor could theoretically bring to the table. So what is it that, according to you, a financial advisor should bring to the table to justify that percent?
It feels like to me it would be worth diving into that Vanguard study, because Vanguard is the index king, right?
Yeah.
John Bogle came out and basically created the index funds and said this is the way to invest, and yet they have come out with a study as to the value of financial advisors. So we can go into that. Before we dive into that, do you want me... can we first just say there are people listening to this that are like, heck no, I'll never hire a financial advisor. And that's okay. Yeah. That's okay. I'd love to just talk to them for just a second.
Yeah, do it.
And then, okay, so if that's you, you're super DIY.
You could break the fourth wall.
Can I look at the camera? Right listen, people. No, so it's weird. If that's you, there are some moments in your life where you will need someone to help a little bit. And you probably should consult with and look for a project-based financial advisor who is willing to lay out a cost that might be a couple $1,000, it might be $10,000, it might be $20,000, depending on your situation, where you can pay that fee and know what you're getting from start to finish, and you can keep your hands on the reins of the investment portfolio. I met with somebody not too long ago who has a very complex investment strategy around selling covered calls, and that is his primary investment strategy for his portfolio for retirement. It's not something, we've used them before, but mostly to exit concentrated positions, so it's not something that we would take on that responsibility. And so then that person needs to maintain control of that strategy if they truly believe that's the best thing for them. But once again, those covered calls are not going to tell them when they can retire, how to take Social Security, how to do your taxes. So there's a moment in various milestones in your life. Find somebody who you can define exact, flat dollar amounts or hourly or something like that. Probably not a long-term retainer relationship for that person, unless that's what you want. You want to have an ongoing conversation about your financial planning outside of your investments. That sounds great. But, okay, so DIYer, basically I'm saying, like, we love you. Everything's great. People like me exist not for you, maybe, I guess, from the podcast and stuff, but people like me exist to help everybody else who are having a hard time putting it all together, and find some people who are willing to do advice without execution on your strategy, without like implementation. They give you the advice and you can go and implement for flat fees. And beyond that, just be aware that you are then responsible for managing an execution and making it happen. Okay, so that's the DIYer. And then let's dive into so Vanguard did this study, and it's called Quantifying the Evolution of Advice and Its Value to Investors. So they went through and they said there are different activities that an investment advisor, and I want to be very precise and call out the words we're using. Investment advisor is what they're talking about, not financial planner, not wealth advisor overall, not financial advisor. Like they're talking about investment advisor in here. So the investment advisor, so each line is a different activity. So suitable asset allocation using broadly diversified funds, ETFs. So in other words, there is some value, and they quantified this as it's somewhere bigger than zero. It's like, thanks a lot. I could have written that.
Yeah.
No, but I'm saying, in all fairness, I get where they're coming from. There is some value, hard to quantify, hard to know how well you could do that on your own, but there's some value in someone stepping in and saying how much of each of the 5 to 12 different asset classes through index funds should you own. And there's some value there, right? Cost-effective implementation. So they use the terminology basis points. 30 basis points equals 0.3%. It's a bond and finance. In the bond world, they never talk about 0.3%. They'll say 30 basis points. 1 basis point is 0.01%. They will always talk in basis points. And the article here does. So 30 basis points or 0.3% improvement just from cost-effective implementation in the actual investments. So it's what they're saying is, on average, the individuals doing it on their own miss out on about 0.3% of maybe better funds or lower cost funds that they could have had access to had they known or been in the industry or had a financial advisor to help them. So for a lot of financial advisors, that's a third of their fee, and that seems I think they're giving advisors too much credit. And let's just throw that out there before we finish, because your listeners are going to tear me. They're going to get in the comments before we finish talking about this. They're giving advisors too much credit, but it's coming from the index shop. You know what I mean?
Yeah.
Anyway, okay. So rebalancing, 14 basis points, 0.14%, just because the financial advisor is in there regularly rebalancing between. I mean, think about it. If you had half your money in a bond fund and half your money in the S&P 500, and 2008 happened, and half your portfolio got cut in half, so you lost 25%, and you took from bonds and rebalanced back to half and half, you just bought stocks at the best buying opportunity that has existed in the last 15 years. So that's an opportunity where just rebalancing naturally forces you to buy stocks. And by the way, when we have the conversation with people, if I have to convince the scared client that it's time to buy stocks when the world is falling apart, then I would say half as many people actually get that rebalancing done. Whereas if we have the ability to execute on that, we can pull the trigger and make it happen. But people are nervous. And I mean, it was a tough time. Big financial institutions going down every day. But that was a tough time, and it was the best buying opportunity in the last 15 years. So, okay, so that's rebalancing, and that's 14 basis points. That's one where I actually think it could be more. And during COVID, we did some strategies around after the market dropped 30% in very strategic rebalancing that I think there's a little more opportunity than 14 basis points. Behavioral coaching, 0 to 200 basis points. And 200 basis points sounds like a lot. That means 2%. So somewhere between 0 and 2%, I can count. I know for sure that there are clients that during the awful times or the good times are trying to do the exact opposite of what they should be doing. Yeah. Everyone wants to sell after they've lost money, and everyone wants to buy after they've made money. And that coaching, it's so funny. Like, think about this. This is the only environment where everybody's like, it's so expensive. I want so much of it right now. You know, like you don't go to the grocery store and you're like, that milk is $10 a gallon. It must be so good. I want to buy more of it. We just don't think that way. But when it comes to investments, we do. And we shouldn't. So anyway, there's some of the behavioral coaching. That's real. But the studies out there also show that clients don't want to hear it. Yeah. And they don't want to hear that we're helping them with their emotions. And so I guess I'm just going to say it, but it's true. It's true. I have had massive, I want to be careful about what I share exactly, but I have had leaders of companies of hundreds of people call me in a panic to sell even during COVID. So it doesn't matter how difficult of things you deal with in your life, how many people you lead in your life. When it comes to your money and markets being down at difficult times, something changes psychologically.
Right.
Okay.
Well, and I think that to our point of even the Yahoo News article that we're reading, like articles will come out. The news is this 24-hour news cycle of trying to put out messages that will attract attention. And so if you're making your decisions based off of those or a YouTube video or anything else, we're going to talk for however long we talk, an hour, whatever it'll be. But that isn't the full picture. However long we go, it isn't going to be the full picture because there's so many other moving parts going on here. So your behavior, not just the emotions of it, of my money is going down or up, but also the messages that you're receiving from media or your family or your hopes and dreams of what you want to do.
Totally. And like you think, oh my gosh, I just lost a whole year of work. That's what starts to happen in their minds, because maybe they have a $2 million portfolio and it goes down 5%. And they're like, I only made $100,000 a year. I just went back in time a whole year on my portfolio. That kind of thought process can't work. It doesn't work, because it will come back, if you have the right portfolio. Okay, let's go faster on this. Asset location, that's just putting the right assets in the Roth versus traditional versus taxable accounts, and taking advantage of the tax structure of each investment, somewhere up to 0.6% on that. Spending strategy, like how you withdraw from the portfolio, how to protect what's near term, grow what's long term, manage some of that. That's somewhere up to 1.2%. And then the total return versus like income investing, that's the idea of a lot of retirees start to think like, oh, I just have to buy dividend stocks and live off the dividends. But it's more efficient these days to build a total return portfolio and be willing to rely on capital gains as well and other types of growth as well in the whole portfolio. So basically they're saying it could be up to or even exceed 3% in net returns. The problem is that a lot of financial advisors don't do all that stuff. And so a lot of people get the raw end of the deal and they pay 1% and they don't do all that stuff. So I do think Vanguard's being a little bit, ironically, like too kind to financial advisors, because a lot of them don't. But I think what they're saying here is a good one can.
Yeah.
And a good one does. But going back to all of this, is my opinion is that you should, as a financial advisor, you should make back your fee, if possible, in each component of financial planning. And right now we have just talked about investment management. So if you can make back your fee and then some in those activities we just talked about with regard to investment management, then if you offer anything else on the side, that's it in addition to what your client is paying for, basically.
Yeah.
And my thought is I want to add that feedback, that 1% back in investment management, but I also want to add it back in tax strategy. And there are certain clients in certain situations where we can save them enough thousands of dollars in taxes with analyzing their tax return, auditing it, coming up with ideas, mocking up scenarios, maybe saving them the Part B IRMA adjustments, maybe something like that. Social Security, if we can find an extra $20,000 to $40,000 to $60,000 over their lifetime, that's not a ton, but that can basically cover several years worth of help. So once again, if you can go back to income planning, tax planning, investment planning, and you can make back your fee in each one of those, then the client should be pumped to have you on board, because then it's like they paid for an investment advisor and they got a financial planner for free, or they paid for an income planner and they got an investment advisor for free. You get the idea. You really have to work hard to make it back in all those categories.
Maybe you can help break down what those categories are. We've talked about investment management and kind of what are those basic levels of advisors, and should an advisor or a good advisor be able to offer a certain number of things just standard, and then as you get into, I don't know, more better or more specialized advisors that are focused on other areas. Does that question make sense?
I think so. Breaking it apart into tiers. Tier 1 being investments, so investment management. If that's all you're getting, we've determined it could be worth it. My gut tells me it's probably not. So if all you're getting is investment management, there are some great ideas of how to build a portfolio out there with index funds, and you'll probably do okay. You won't have as sophisticated of strategies, but sometimes the simple ones beat the sophisticated ones. So okay, so that's tier 1. Tier 2, this would start to get into things like income planning. So for a saver, this is how much should I save? In what accounts should I invest? How should I structure emergency funds? Debt management. There's a lot of building a strong financial future that is very conversational about how do you manage your own resources, meaning your money and your time and your family. Like, how do you handle all that? And then for a retiree, it's going to be more along the lines of that withdrawal strategy. How do you set up the portfolio in the right way? How do you actually know you have enough to retire to pull that trigger? How do you know how to adjust it to never run out of money? How do you handle inflation over time? Those are all withdrawal and retiree income planning. So that's all income planning. Even things like, I think within this same tier 2, you should be getting things like marginal tax bracket management. But we're starting to get into stuff that most financial advisors don't offer, but I think it should. I think every financial advisor should be doing a base of investment management, income planning, and tax strategy. Without those 3, so could a financial advisor be worth it on just one of those? Yes. Is there a financial advisor out there doing all 3 for the same price? Yes. So does that make sense?
That was a very nice way of putting it.
Yeah. So if you're not getting all 3 of those components, I think you have an opportunity to improve your relationship somewhere. Yeah. Okay. So then, retirement planning is really a big part of number 2. I think we can move on to 3. Or is there anything you would add within investment management, retirement planning, which is kind of like cash flow management? Like, what are you doing with your dollars to get ready for the big goal?
Well, and we've talked in the past too, and it became a big thing when Dave Ramsey went off on the 4% rule. But it seems like if in that retirement strategy, you're able to find them opportunities to manage that in an appropriate way, even with your fee, that 4% might change. Like, it might be a more beneficial situation for people if it's managed correctly versus on their own and not knowing certain things. So it's not just the fee coming in, but it's their withdrawal percentage rate.
And the industry has gone back and forth on this. I think in general, I've never been super comfortable with the 4% rule. And then everybody said it needed to go down to 3. And I'm thinking, are we crazy? Like, there are too many people living poor with a lot of assets because they've been told they have to only spend 3 or 4% of the portfolio. Now, depending on their age, they might not be able to go much more above 5.5 at early, right? But the 4% rule was not made for somebody who's 75 years old. It was made for somebody who's 60 or 65. And the 4% rule wasn't even really designed to be the end-all, be-all decision maker around how much you can withdraw from a portfolio. It was meant to be another marker, another way to analyze it. And so in other words, a good financial advisor, a good retirement income planner, let's call it. So there's another acronym, RAPC, Retirement Income Planning Consultant. There are these, but I wouldn't use the acronyms and the designations to determine who you trust. I would use their advice and test it out and see what you think. But the bottom line is the retirement income planning done right can usually allow you to spend more at the right times in your life.
Yeah.
So anyway, that's all tier 1 and 2. So if you're not getting that, and you're paying, let's call it a full fee, anywhere from 0.9% to 1.4%, somewhere in there for a financial advisor, then I think you can do better.
Well, and I want to further emphasize, because we talk a lot about it on the channel, and then it's kind of the specialty that Capita does in terms of Social Security planning, I think falls into that retirement and income planning section. So Social Security in and of itself is a behemoth system and program that people get to interact with at a certain point in their lives. And so determining not just the break-even analysis, that's the simple one, but we've got videos on it that people can go watch that goes into more depth around that. So Social Security, I think, falls into that.
Yeah.
But it is a specialty specifically that you focus on at Capita, which I appreciate.
Right. Yeah, and Social Security, for whatever reason, is an area that retirees really, really focus on, even if it means almost nothing relative to their wealth. I mean, you'll have people with $5 and $10 million in assets that are bent on getting the Social Security strategy just perfect, which I love, because maybe they're trying to, like, I paid all these taxes, I got to get it back. They're just angry about the whole situation. But they do hone in on it very, very precisely. And in most cases, $10,000 to $100,000 over the lifetime is what we find we may be able to enhance for each individual based on their Social Security filing strategy that maybe they would have done on their own, versus us knowing the rules a little bit more and knowing what other options they had available to them. The most I ran into was somebody where they were missing a survivor benefit and they had to take a couple action steps to be able to unlock that survivor benefit, and it turned into over $600,000, what we estimated if she lived till 90-something, additional income. So that, that's enough money that that would pay a 1% fee on a $3 million portfolio for 20 years. You know what I mean? So then basically not that we want to make all of a client's gain. We want to do that 4 times over for them if possible, right? So that we've added way more value than we've taken if possible.
Yeah, let's move on to tier 3 of what financial services could you offer on top of what you've already discussed that might start to justify that 1% fee or more coming from there?
So this would be things like more comprehensive tax analysis and more comprehensive estate planning discussions and analysis. And then areas like insurance analysis. I mean, it's interesting because a lot of financial professionals will hit insurance first, and that has to do more with their licensing and the product offering that they can give versus what's needed. In my opinion, you kind of look at life like you're in this ship and it's going along and you've got a couple holes in it and you got to plug those first, and then you can breathe and then really build wealth. So the holes you got to plug first are things like make sure you have an emergency fund, get rid of credit card debt, make sure you have enough life insurance that if the primary breadwinner passed away, that you don't leave your family in a huge problem. Low cost term life insurance for that as early as possible, so that you can get it when you're healthy and you don't lose your eligibility. I had cancer. It's been 10 years ago, I think, or close to it. I can't really get life insurance because I've had multiple surgeries over the course of the decade. So it becomes really difficult. And now my goal is just try to grow my wealth as fast as possible as my life insurance. I wish I would have had more. I did have a lot, but I changed my job and that life insurance didn't get to come with me. And then now because of the health record, I can't get it. So anyway, emergency fund, credit card debt, life insurance, and then don't miss out on free money that you might get from your employer. Even if you're struggling with all this stuff, just get the free money in the 401k. So those are 4 holes you plug in the ship. Then let's come back to insurance later. And this is where in tier 3 is where I think it belongs, where now let's talk about things like the full review of your property and casualty insurance. Do you have an umbrella policy on do you need it? Do you need professional liability insurance? Do you have disability insurance? Is it own occupation or not? Or, you can see how all of that, the different insurance analysis comes into play. If you're closer to retirement, do you really want to look at insured options of pension-like income that annuities can provide? Or are you good without that protection? And anyway, that to me is a tier 3, like additional service that should be looked at. But in that tier 3 as well, I think before that even is tax, like a deeper tax analysis. I mean, we have the ability where we throw tax returns into some software, analyze them, audit them, mock up scenarios, play with, add extra income, add extra IRA withdrawals, add extra Roth conversions, add more charitable deductions so that you can see what the effect of all of that is, and then give clients an idea of if you do this, then X will happen. Most of the time, accountants are so busy and they're looking in the rearview mirror in the beginning of the year, and by then the pie's baked. It's too late. So we try to do that throughout the year, especially second half of the year, to be able to catch opportunity. So that's tier 3, in my opinion. And then estate planning in tier 3 is more of like, how do you save your family from hating each other? If you get enough money, there's a risk.
Yeah.
And how do you make sure that everybody understands not how you're just transferring your money, but how are you transferring your values? That's really what good estate planning is about. I mean, everybody needs the basic, here's how the money transfers, but the next tier is how do we transfer what we believe, the values that we have, and like if you're big into helping the world and giving and your time and money, how do you pass that along? That's actually part of estate planning, believe it or not. Done right, that is.
Well, and I'm coming off of that relatively recently with a parent. And so I think it seems like a lot of times with the estate planning conversation, it is, okay, my mom passed away. That had a lot of impact on us as the kids and making sure that she had some things in place, because even with certain things in place, there's still disagreements, and to have that in a way that is able to be resolve itself was fantastic. It's a kind of like a big conversation. And maybe that's a teaser. We're in talks with something that might come around that we can offer people, which is fantastic. But estate planning is a big thing. I think, again, you don't know you need it until you do. You don't realize how important it is until you need to deal with it. So anyway, that was...
Yeah, most people need it. Most people need foundational planning. Anybody with a home you're basically to the point. Home and kids, those are your triggers. Like if you own a home, and it doesn't have to be owned outright, you can still have a loan on it. If you are on title as owning a home
Yeah.
and you have children, or you have children, it's or either one, you need to be thinking about estate planning.
Yeah.
And you don't need to be super wealthy for it. You need to be thinking about it at that point. Now, when you end up with a lot of money, that's when you need to start thinking about, is my family going to fall apart? And they might fall apart over something that doesn't cost very much, like something special or sentimental. So, outlining that stuff. And then the third level of estate planning is, okay, we have it organized. We do have assets. It is very well laid out as to who gets what and when and how, but you still haven't passed your values on. Now, I shouldn't say that entirely because some parents are really great at the conversations all throughout their life, but it's probably worth it at some point to have a real conversation around, we view money as this. Maybe it's safety, as a security, as a moat around the castle, or we view money as the tool to create good in the world. So if you just build a massive moat around the castle, we're not doing enough good in the world. Like that, how you might be talking about values, which might be like the relationship values and other parts and how you create and live in the world. But you need to talk about how money plays into those values and how money supports those values. That's the next estate planning. So this whole conversation is around, what can a financial advisor do? A good financial advisor, this is what I call tier 3, can get into this conversation and say, hey, we've taken care of really great investment management. We know your retirement plan's on track, and we know we're optimizing tax strategy here. Your insurances are in place. We're covered around the big what ifs, and nothing's really going to destroy your castle. You have a pretty decent moat. Now what are we doing with life? That's the advisor instigating that. I want you to think a little bit harder about what money really means. That's the estate planning in tier 3. And then if you get to the last tier, which is tier 4, this is very specialized planning categories. Like I know of a financial advisor who has special needs children, and he is, I listened to him present on special needs trusts. I don't think I'm comfortable advising a special needs family on third-party trusts, first-party trusts, the 529 ABLE accounts, and how all those interact with each other. I feel okay, mostly because I listened to him. But if somebody really, really wants an expert in that space, it's him. It's not me. So that's one area of specialized financial planning that is in tier 4. I think that person still needs to do tier 1, 2, and 3, but then tier 4 is where we differentiate ourselves. So see if I can summarize all, well, and maybe give a couple other examples. Divorce planning can be a tier 4. There are examples of, my understanding is let's start over. Retiree, like transition is kind of one of these, but I think it's tier 3.
Yeah.
I think everybody needs to know how to do that really well. But I know of some people that specialize in transitioning assets from one generation to another. And a great example of this is, I believe there's a theater on Coronado Island that still operates as a theater because there's this special rule, I think it's 2032A, and it's mostly used for farms, but in this case, they can value the estate at the value of the business operation rather than what the land in that area is worth. So imagine a piece of property on Coronado Island being really, really expensive. When they pass that from one generation to the next, they don't have to pay estate taxes on the land. They can show the value of the theater, which is probably not operating at a gain. and so, but they have to do it for like 10 years or something like that. That's what 2032A. Ranches, big farmland areas. My family's been up in Wyoming for years, running quite a bit of land on a ranch. And I think this is something they think about and work on. Anyway, that's a specialty that a particular advisor could really help a family walk through. Complex charitable giving of businesses instead of stocks and bonds and things like that. So that's all tier 4. And like business exits, consulting, there are some advisors that specialize in teaching dentists how to set up their business to sell. Like you would think a financial advisor is taking the dentist's money and investing it, and some do. But some actually get involved way early to maximize the value of how it will sell to the next partners and help them through the whole process. So that's all tier 4.
Wow.
That's a lot.
It is a lot. And it seems like as you're going through those tiers, tier 1, tier 2, just coming from Erik's perspective of, it's like, okay, I'm getting an income, I have money, where do I put it to plug those holes, right? Like, let's plug those holes first, then what? And there are some opportunities from kind of using Vanguards from zero to who knows what in terms of the gain that I could see from these activities.
You mean from the activities of a financial advisor helping you, or from the activities of just investing yourself?
Both, like a financial advisor, or if I'm super DIY, there are some opportunities for me to find opportunities to grow my wealth, to grow my assets, to put my dollars in strategic ways that will benefit me and my family. And as you start moving up these tiers, and now you're getting into the last tier with business structures and with these complex situations, it seems like there are some huge opportunities, but you have to know that specialty. And there are kind of assets that are bigger that are being involved with here in general. Usually. There are exceptions, of course, but
yeah. And I've actually gotten to know one of my areas of focus has been helping a business owner who already gives to charities. So I'm not trying to tell people to give their money away to charities, but somebody who owns a business, also gives to charities, and is potentially going to exit. There are some strategies there that can help minimize the capital gain when they actually leave their business, when they sell it. It requires some foresight and planning way before they actually sell. But I've gotten to know clients in that area, which is for sure tier 4.
Yeah.
And then we kind of go backwards, and then we go back in and work through tier 1 and 2 and 3. But just as an advisor, I think your best chance to find clients is by standing out in tier 4, because the terrible advisors in tier 1, 2, and 3 and the great advisors in tier 1, 2, and 3 are really hard to tell the difference from the outside. So from a consumer standpoint, they struggle to tell us apart. And I don't blame them. It's hard. But the tier 4 kind of helps people see some alignment and like, oh, this person knows so much about what I'm dealing with.
Yeah. That's awesome. Let's talk a little bit more about that percentage fee kind of as a wrap up here. And I want to bring in what I've been hearing in the feeds that come across my world, and then jump into kind of more of what you touched on in the beginning of project-based, the different compensation structures outside of just the percent of assets under management. So one of the big things that goes around a lot is if your investment advisor is charging 1%, that's 28% of your gains over the course of your, I think it was 20 years. So 20 years, 28% of your gains are gone going to your financial advisor. They're ripping you off, and then it kind of goes down that line, which we've touched on. So maybe you can help all of us understand what that actually means and where the opportunities that you've talked on can justify that.
Sure. So what they're saying is, if you're paying a fee, and I don't know what numbers they used exactly, but you're paying some sort of advice fee of assets under management per year, and all other things are equal, meaning your rate of return would be the same if you used the financial advisor or didn't use the financial advisor. So they're using, let's call it an 8% rate of return. On one side, you get the full 8. On the other side, subtract out the advisor fee. And then what did the balances end up at the very end? They're saying you have 28% of the total return is lost to the advisor fee in the advisor scenario, which is true. I mean, that math probably does shake out really well. So the question is, are you truly going to get the exact same rate of return? And in some cases, you might get worse with a financial advisor. So, I mean, you know what I mean? So it might be more than 28%. It might be 50% if they do poorly. But the reality is a good financial advisor can make that back multiple times. So we messed around with an Excel file where we said, okay, over 20 years, these aren't rates of return that we're like quoting or anything. We're just trying to use a calculator to guess on some things. So if you said like you're pretty conservative, kind of moderate growth investor, and you're getting 7.5%, and you're paying a 1% fee on one side and you're not paying a fee on the other, then overall you'll end up with a lot less money if all things are equal. We did a quick math on those numbers. It's 25%, about 25% difference that you lose. Now, let's say that your financial advisor can, through tax strategy, make up $2,500 a year, which really isn't that much when it comes to tax planning, like optimizing someone's tax return and finding them $2,000, $2,500 over the course of, the total benefit, per year. That's through a good Roth conversion strategy, through bunching charitable giving, through using qualified charitable distributions. Like there's a lot of different things you can do there. That actually leaves you with about, not a ton, but $17,000 more with the advisor at the end of the whole thing. So that's just the tax side. Now, if that financial advisor prevents you from selling in the bottom, all bets are off. Throw the calculator away. They may be paid for their entire lifetime with you, depending on how that would have gone without them.
Meaning, going back to what you had said, if they lost in a depression or whatever else, they lost all that money, and then their advisor is helping them realize that that's an opportunity to buy, and the gains that come from that,
and
could pay for
just
that.
Not sell, but also to buy. Those are both hard things to do.
Yeah.
So again, I'm not trying to. Please don't take this to anybody out there. Like as I'm saying, like everyone has to have a financial advisor. I have met some incredible DIY people who are really good at this. I also know a lot of people that change their own oil. I don't, in my car. So, okay. Going back to, that was an example of like the math just with a little bit of good advice can be completely flipped, and the advisor could be worth it just on that alone.
Yeah.
And that would be the advisor literally doing nothing other than putting you in the same index funds you would buy yourself, analyzing your tax return once a year, and finding $2,500 of additional tax savings through different strategies. But usually an advisor who does that for you is also doing about 4 or 5 other things that also add, $1,000, $2,000, $3,000 a year. That's not a pretty small balance. I mean, if you multiply that by 10, it's going to be harder to find $25,000 of tax help, but then the opportunities in other areas through trading in the portfolio to minimize capital gains and helping with other areas become greater. So there's other opportunity there.
No, I think that's great. I think, and we can share this calculator with people. Again, it's not like a scientifically optimized thing. It's just real quick, throwing some numbers together that you can mess with. But
I do think it's important to talk about the different, because we, in the other video, we did insurance, broker-dealer, investment advisor. Those are the 3 different licenses. But within this investment advisor space, which is pretty much all we've talked about today, there is the advisor who's charging a fee on assets under management. There's the advisor who's doing a flat project-based fee, or an advisor who's doing an hourly rate, or the advisor who's doing a retainer.
Yeah.
It's just a constant every year, every quarter, every month that we charge a certain amount per period. What do you think would be helpful for your listeners to know about those 4 different arrangements?
Well, and selfishly, I think that this is helpful for us as well, is that we get people who reach out, and we love to help people. Specifically with Capita, you're under the % of assets under management, with some exceptions of like the divorce planning and certain things like that. So if somebody is reaching out and they're like, look, all I need is help with one thing. Do you do a flat fee or an hourly arrangement? No, Capita doesn't do that in these cases.
Not for what we believe are long-term planning needs.
Right.
So if there's a temporary planning need, so things like retirement planning, whether you're in retirement or getting ready for it or saving for it, that's a lifetime planning subject. So we don't do a flat fee for that. And tax strategy, could you build a once a year tax thing? Maybe, but what we found with tax strategy is normally the best tax strategies are oftentimes ones that you purposefully take income in order to reduce income in the future. And so we want to see that throughout multiple years of planning. So anything that's over lifetime, we don't do project-based. We hope that you're not getting divorced for your entire lifetime.
Yeah.
So that's one where let's have a start, let's have an end to that. Let's have that be a defined amount, and then we'll move on. And so far we've seen a lot of flat fee planners add the assets under management fee later. Mm-hmm. And we've seen a lot of assets under management people add the flat fee like we have for certain and specific things. So it's one of those situations where I think some of the best wealth advisors out there are actually doing both. And depends on the situation. I have found that the ones who just do flat fee oftentimes are very, very wonderful people. They're probably like the most altruistic people in our industry. but oftentimes they don't have the same incentives to execute the strategy for you because they're not actually diving in and managing as much. And there's risk when you start taking on someone's money and you're trading in the portfolio and executing on that strategy. There's a lot of risk in getting that right, like legit financial risk in making that happen just right, that you can be liable for. So most of the time, a flat fee planner is not going to actually get in and create access to your portfolio and start trading for you and managing it for you. There's too much risk without being compensated for that. And so anyway, that gets you an idea as to why. Let me put it this way. Capita is of the belief that in order to make our clients the most successful, we'd like to get that, you remember the Staples commercials with the big red easy button?
Yeah.
We'd like to get that and slide it across the table and say, this is how it's all going to work for you. If you're ready, push the easy button and we go to work. And then the flat fee planners are more like, they make it easier, but it's not as easy as please go, get it done.
Yeah. And I think you hit on it beautifully of there are instances in life or moments in life where for even the DIY people that they do gravitate to those people.
Totally.
And you talked in the other video about incentives, like a flat fee arrangement incentive-wise is very aligned in terms of dollars and everything else because everybody has an incentive in the professions that they do. And so it is very aligned. I went to Hawaii with my wife, so I'll just do a quick story.
Go for it.
And we found this waterfall. We just Googled it. We found a waterfall to go visit. And it was super treacherous to get down there. In fact, there are a lot of signs that say don't go down there, but we're rebels. And so we just, we're not. We're super conservative people. But we wander down there and we run into this gal and another guy just talking to him. And the guy was a hired tour guide for this gal visiting Hawaii for the first time. And
So I have many questions here.
Yeah.
Were your kids with you?
No, just me and my
Oh, okay.
wife. Yeah.
And this person had a travel guide just for them.
Just for them.
It's a different life.
In Hawaii to take them to all the best spots. And so we hiked down to the bottom of this waterfall and we are the only ones at the bottom. There's this observation deck up top and everybody's up there. My wife and I happened upon it, but the tour guide knew exactly where to go. He knew how to direct her through these super steep hills and ropes and things to go along. And then we get down to the base of this waterfall, which is absolutely amazing. And he was like, hey, I'm a local here. You can actually go behind the waterfall. And so he takes us behind the waterfall. And so we're standing there and looking at this. So we have this unbelievable experience that the gal who had hired a tour guide was able to take her on and we just stumbled upon it. But the point is that the tour guide was there traveling with her, taking her and helping her through the entire process throughout that trip. Whereas from a DIY perspective, we could have missed out on something. We didn't in this case because we fell into
right.
this person.
No, and to further your example, the planner is the compensation for a project-based hourly or flat fee planner is to provide you with advice and ideas and then let you execute. And some of them will jump into execution a bit too. But the product is ideas and advice, which is great. That would be kind of like that travel person that you're talking about, like writing up the report as to how to make it down that mountain and they still know about it. They still know what they're doing. They're really smart but they didn't go with you all the way down the mountain. And that's kind of the difference that we see. Now, in all fairness, you can do a flat fee retainer and they can do most of the things because they're with you the whole time. But once again, it goes back to like who's going to place the actual button, push the buttons to place the trades, to get the activity done, to open the accounts, to transfer things, to organize, to create balance sheets, net worth statements, things like that. That's where we find that's different alignment. But both are great. Like once again, like if you're a DIYer, you don't want that easy button. You want all the levers to pull. Keep all the levers and get the right advisor for you.
Yeah. No, and I appreciate you being willing to share the pros and the cons of all of these. And you do it on the other video as well of like, we aren't trying to bash everybody and say yours is the only way. It's very much, there are a lot of good people out there that can help. There are also a lot of people with titles and acronyms and everything added on to the end of their name that aren't. So I wouldn't make your decisions based off of.
Yeah. Can I give you one other thing on this investment advisor, mutual fund, hedge fund, kind of bring everything back around at the beginning? Sometimes it's really hard to tell the difference between a financial planner who also is helping with the assets under management versus an assets under management salesperson. So some people actually create their own funds and they come across like they're a financial advisor. And they even will start to talk about retirement planning with you, but they just don't have the knowledge around all of the wealth planning topics to really help you through. Anyway, I guess what I'm saying is just be a little bit aware of within this investment advisor space, you have the AUM, you have the project-based fee, an hourly fee, and a long-term retainer. And then within the AUM, assets under management, that is, you have some that are doing full financial planning and some that are doing investments only. And that needs to be a distinguishing, like fork in the road. You need to identify who you're talking to. And if they are doing what they all call holistic financial planning, are they doing tier 1 and tier 2 that we talked about earlier? Or are they getting into tier 3, which I think is I used the word table stakes the other day, right? A minimum level to be at the table, a minimum level of service that I think tier 1, 2, and 3. We made some notes on that. So that would be things, just to review, like income planning, after investments, income planning, retirement planning, tax strategy, and then moving on to things like estate planning and insurance. Like all of that needs to be offered if you are going to be calling yourself a holistic financial planner.
Yeah. No, this is great. I sincerely appreciate every time you come on here, and all of the viewers appreciate when you come on here, and you get more comments on how you look like very attractive celebrities.
Hey, I'm still, my heart still hurts for the one that said I have small hands, because I can't tell you how many times I've been looking at my hands in the mirror. Like, are they really small? I thought they.
It's so funny how the comments stick with you. So for those
they really do,
who made
don't
it
they?
this far, I mean, maybe you can comment on his small hands to prove that you made it to this point.
That is your thing, right?
Yeah,
You like to put something at the end so
Little
you know
Easter
who
eggs or
actually
something.
listened to the end.
Yeah.
I would actually love to hear all about these hands. They're not that small.
They're very good size hands.
Anyway.
But if you need help with any of this, again, my email's in the description. We'll put a link to you. You have your financial call and the guided path, which is unbelievable for anybody who does want to DIY. Like, that's unbelievable resources for them. But also, if you need help with any of this and you want the easy button, then we'll have links for people.
For sure. Thanks, Erik. Always fun.